Welcome to Access a Trader, the #1 community for high-level traders to learn valuable trends and strategies, connect with other top traders, and become consistently profitable. Click the link in the description of this video to receive a special offer on our revolutionary PS60 training, access to our daily chat room filled with experienced traders, and so much more. Space is limited, so make sure you don't miss out. We look forward to seeing you in the room.
Today's topic is the difference between risk on and risk off. Okay, obviously, process is a very, very important part of what we do. Any trader does. Again, if you're trading commodities, or if you're trading, bonds, or if you're trading forex, crypto, even crypto, which I have zero knowledge about. But anything that you're trading, you need to have obviously a process. You could be the greatest trader in the world, but if you have a flawed systematic approach for protecting capital, then your process gets diminished. Doesn't make it. You could be hitting stocks 9 out of 10 times, right? Hitting your option trades 9 out of 10 times, but for that one time, if you completely misstep, and again, we're all human beings. You even see me do it once in a while as well. I'll misstep and I'll overstay my welcome in a trade, and next thing you know, you're turning a paper cut into a severed head. So we want to address the difference between risk on and risk off. Okay, now traditionally, what is risk? Okay, what I do for a living, and what a lot of my buddies do for a living, a lot of traders in general do for a living, they are systematically entering, whether it's some sort of derivative of a stock, option, futures, whatever it is. They're putting on risk, and risk capital is the allocation within your account, within your trading account, that you are putting on the line. Okay, you're putting on the line, and you are evaluating risk for a possible appreciation in your account. Okay, that's what risk is. Okay, is it gambling? I don't believe it's gambling. A lot of people say, well, if you're putting your money on the line, there is some sort of gamble behind it. It's the quote unquote the unknown. I disagree with that. Okay, I think when you're putting money on a baseball game and Clayton Kershaw is going against some guy with an ERA of 9, is that a sure thing? Yeah, most of the time it is. Okay, most of the time it is, but for that one time, Kershaw could blow up in the first inning. And that's what kind of what trading is. It's the high probability, okay, the high probability money allocation with defined risk completely behind it. And so when we talk about risk on versus risk off, it's the ability to try to eliminate as much of that exposure as possible. So as you guys know, the PS60 theory is completely different than anything else out there. Anything else on the internet, you can go on YouTube and you will find 30,000 different videos of how to do something. So for example, if you wanted to see a video on opening range highs, you go on YouTube and you go, well, here's opening range highs, 3,000 people. If you want to have a video on how to trade weekly options, I'm sure there's 30,000 things there as well. The PS60 theory, yes, as much as there is content that we've especially recently started to provide on the topic, there is nothing out there that is tangible, actually tangible or intangible. There is nothing out there in the cyber universe outside these walls that talks about this process. And the reason is because, again, I stumbled onto this about 3.5 years ago, and what we've seen in the room, especially in the last 3 years, has been, I don't want to say the finished product, but it's definitely getting closer. Okay, there's no such thing as a 100% system. There's no 100% process, but we're trying to get there. Just like being human beings, nobody's perfect, but we're trying every single day to get as close as possible. So the one thing that everybody knows about the PS60 theory, and again, this is why the live room of you guys see me talking, and you see my executions, and you see all that good stuff, it's live because we want to make sure the process plays out live. Anybody can go on after the fact and say, hey, look at this chart. We bought the stock at 30 and the stock went to 40. Oh, this is great. This is fun. We all know trading is not great. It's not fun. It's a job, but we try to perfect it as much as possible. So the PS60 theory has two elements of it, okay? And this is based on strictly for the conversation of risk, okay? There is the time factor, okay? There is the time factor. Unlike any other defined risk process, time is a very, very important element to entering, maintaining, babysitting a trade, but most important, exiting a trade, okay? And a lot of people are home right now and saying, well, what's this guy talking about? What's this guy talking about time? I believe in two ways of managing risk, okay? Two ways of managing risk. You could do it via percentage of your account, or, actually there's three ways. You could do it percentage of your account, you can do it via time interval, okay? Or you could do it with actual risk, okay? So let's talk about that. The first element of risk, in my opinion, and I've been saying this for new traders all the time, I think, because people ask me all the time, what is a very feasible allocation that we should put on for exposure of risk? What's the percentage allotment of our account that we should put on the table that we could risk per trade? My always answer is, if you're going to establish any type of risk, okay, any type of exposure, I don't believe it should be any more than 1%. Okay, I believe that 1% risk is a satisfactory exposure number on your account. So for example, if you have a $30,000 account, your maximum risk per trade should be $300, 1%. If you have a $50,000 account, $500, $100,000 account, right, $1,000. If you have a $2,000 account, I'm sorry, spoiler alert, you shouldn't be trading. It is what it is. So if you do have an account, that is risk on, and I guess the word is pattern day trading, right? Again, a word that I've recently learned in the last 3 years. I had no idea what this word even was, coming from the prop industry for years and years and years. If you are able to put yourself in a position that you are above the pattern day trading rule, then I believe that 1% should be very satisfactory, a number that you should be exposing yourself for every single trade. And what you want to do with that 1% is completely maximize your risk to reward ratio. So let's talk about this, okay? Let's talk about that allocation of 1%. So let's, for example, pretend, for example, that we're trading, let's just use an easy stock. What's like a $5 stock, which I know is a silly example. All right, let's just pretend it's Mankind. This is literally the first $5 stock I could think of. Obviously, predominantly, what I trade is high beta, your Googles, your Amazons, your Teslas of the world. But for the point of discussion, I just want to make it easy, with easy allocation of shares, just to show you guys. So let's pretend, for example, that you have a $25,000 account, right? Let's pretend you have a $25,000 account. So forget about all this. This is already in la la land. This is already people chasing. There is no defined risk. There is no safety net. These are just people, uneducated people. And again, unfortunately to say, lower tier sized funded accounts. Nobody in their right mind with any type of sizable account is trading this thing, especially up here. Not to the long side. Definitely not to the long side. But let's pretend this area right here. Okay, let's pretend none of this existed, right? So let's pretend this whole area right here is $2.50, right? The top of this channel is $2.50. Okay, so the one thing you're always asking yourself when you're putting on risk and you're allocating 1% to that risk is, well, we know my max exposure is going to be $250, right, guys? 1% of $25,000 is $250. So you're saying to yourself, how many shares can I buy, okay, with a maximum risk. I already know my fixed exposure to the trade. What is my maximum risk, what are my maximum shares that I can buy that I can completely take advantage of a risk reward scenario and at the same time maintaining my maximum exposure to the trade. So let's pretend the stock closed at $2.45, right? Let's pretend $2.45. So you know the daily pivot, right? The daily pivot is 250, right? You know the daily is 250. So you say to yourself, okay, the stock is liquid, okay? It's liquid. I can get as many shares as I want because the market is showing me there is enough liquidity that I could take advantage of the trade. And obviously liquidity plays a huge role in how many shares we can actually allocate to trades. For example, a lot of times you see me trying to get into a Tesla trade. There's just no liquidity, so I either pass the trade on, or I just don't get filled enough size. So liquidity obviously plays a part. But let's just say, the previous day high is 250, right? Previous day high is 250, close at 245, and your maximum risk on the trade is 5 cents, right? Maximum risk on the trade. Why 5 cents? Well, close 245, you're buying it at 250, and if it fails at 250, you're stopping yourself out at the previous closing price. So you have a 5 cent maximum risk. So your fixed cost, your maximum exposure is completely locked into the trade, right? Completely locked in. So what does that do? That takes away all emotion. That takes away all forecasting. That takes away any rising levels of anticipation, of fear, of losing control. Every element of emotional baggage is completely removed and put aside to the table because you already know your maximum exposure is 1% of your account. So that lets the trade play out organically, right? It's going to play out organically. And we say this all the time. The market and the stocks in general, they don't care if me and you are in the stock. The stock is either going to go or it's not going to go. So for all you guys sitting at home thinking that you watching the stock tick by tick or you praying to the market gods tick by tick is going to have any justification for the stock to go higher or lower, you're delusional. You're completely delusional. And I used to sit there just like everybody else years ago and say, oh God, please let the stock go higher. Please let it go higher. Oh my God, please let it go higher. Oh my God, there's a huge buyer. There's a huge seller. Oh my God, there's a huge buyer. There's a huge seller. The stock is about to go. Oh, the stock's about to fail. All you're doing is you're burning mental equity. Okay, you're burning mental equity. And the one thing that we know about every single year that goes by, you don't get back that mental equity. You just don't. So what this does is free up your mental equity, okay? It locks in your max pain, and now you're just trying to figure out what is my biggest exposure, okay, share-wise, because if this thing goes, I'm going to make, quote-unquote, a lot of money. Or again, the word a lot of money is all relative to your account. So again, let's look at the example. So the stock's at 250, closed at 245, you have a $25,000 account, which means your maximum exposure tier-wise is $250. So you have to ask yourself a question. How many shares, what's the most amount of shares that I could put on that's going to satisfy the trade with potential prosperity, and at the same time, lock in my max pain, which is 1%, which is $250. And the answer to that is 5,000 shares, correct? 5,000 shares with a nickel risk is $250. So if the stock explodes, right? If the stock explodes, and again, this is obviously, a complete, daydream, right? A daydream. It's phenomenal. Anybody in their right mind who ever probably thought mankind could actually do this. And I'm actually shocked that I'm using mankind as an example, but this is again the first $5 stock I could think of. So your maximum exposure is still that $250, but what you're doing now is you are getting the most amount of shares, okay, minus your fixed rate to give yourself a defined trade. So if this thing goes, and obviously this thing went, you have a potential to have a runaway train on your hands. Now again, this is after the fact. Okay, this is after the fact. Again, in a normal market, you probably be just begging and wishing and praying for this, for this candle. So forget about all this right here. So let's pretend you bought the stock at 250, you got stopped out, you lost $250, right? Max pain 1%. But now you have the greatest amount of shares on, okay, with the same locked-in risk, that if the stock takes off, and in this case the stock takes off, right, and it goes to $3, you are, okay, exposed now to a $3,000 profit versus a $250 max pain. This is over 10-to-1 risk reward in the trade. Now, obviously, we don't know what's going to happen price-wise, appreciation or depreciation, until the trade is done. But you have to put yourself in the position, right? You have to put yourself in a position to find out. So here's a perfect example of your locked-in risk of $250. The stock goes up 50 cents. So you're talking about a $2,500 reward for a $250 risk. So let's talk about, for example, I don't know, even a small, even a name like Tesla, right? Let's just pretend Tesla, right? So here's a chart on Tesla, okay? So you're saying to yourself again, here's the breakout on Tesla. Everybody's looking for that big breakout, right? Everybody knows the big breakout, 360, 360, 360, okay? It's the same thing, okay? You have a $25,000 account, and unfortunately here, it's a little bit different, right? So let's just say Monday, tomorrow, Tesla has one of these crazy days, and Tesla breaks out tomorrow, okay? So the stock closed at, let's just call it 350. I don't want to use 57 cents. So you have a $5 risk, right? Here's a $5 risk. Now you're saying to yourself, how many shares can I possibly buy, okay? What's the biggest bang I could get for my buck and still have a max pain of $250, right? Now here's an example of if you have a smaller account, it's kind of harder to get the bang for your buck. So maybe this is a situation that you say to yourself, maybe I want to trade via the option model, okay, and maybe buy myself some out-of-the-money calls. Again, I'm not really an options guy. It's not really my thing, but I know a lot of people in the live webinar are, okay? But here's an example that you say to yourself, how many shares can I buy, right? How many shares can I buy and still have a max pain of $250? Unfortunately, right? Unfortunately, you're only able to buy 50 shares, right? You're only able to buy 50 shares. Why? Because again, you're buying it at 360, you're using 350 as your stop, right? It's max, you still have your max pain at $250, so it completely removes any emotional attachment you have to the trade. You don't need to watch it every single second. You don't need to watch the stock Twitch feeds. You don't need to watch the Twitter feeds. One guy's saying it's going to 500. One guy's saying it's going to 50. This is all in the same day. All you need to do is obey technical analysis and watch the stock play out organically. So your max pain is still $250. But if the stock goes, right? If the stock goes from 360, your first supply, let's just call it, this is 379, let's just call it 380, okay? You're risking 5 points to the downside, right? Max pain, think about it, max pain, $250, 50 shares. But if the stock goes to 280, right? Stock goes to 280, now you're risking $250 to possibly making 20 points. Everybody see that, guys? Guys, do me a favor, type 1 in the channel. Does everybody see that, guys? Your max pain is still the same. Right, guys? Your max pain is still the same. It's still that $250 area. It hasn't changed. Nothing has changed in your max pain. You're still allocating 1% to your max pain. So you don't need to watch the stock every single second. You don't need to sit by the screen saying to yourself, oh my God, I have to go to the bathroom, but I have to watch the stock. Why? If you're already committed to your 1% max pain and you already know it's 5 points, right? You already know it's 5 points, it's $250, but your upside, right? Your upside is 20 points. So you're talking about, $1,000 to the upside and still $250 to the downside, okay? So your max pain is set, your initial reward is set, and again, the greatest part about it is you are not burning emotional capital. We don't get that back, guys. Again, sometimes, we'll get to like Thursday and Friday, and I'm sitting there and I'm watching Tesla, and I'm already burnt out because I'm so tired throughout the week. And I put in a pivot in the room and say, hey guys, watch Tesla. If it gets above, 355, 30, it should go to the next supply zone. And the stock explodes, and I didn't take the trade. And somebody says, well, why didn't you take the trade? And I was like, I'm too tired. I'm like, well, why is this? How tired can you possibly be clicking a mouse? But the problem is, it's not the act of clicking the mouse, it's the act of completely being embedded on another risk-on model. So burning mental equity is a big deal. So if you're trading the 1% maximum exposure, what that really is doing, and subconsciously of course, number one, it's teaching you to slowly remove yourself, right, from the emotional carnage that a lot of traders are still attached to. It's giving you defined risk, but the most important thing is it's giving you defined reward. So if you're a trader and you believe in the theory of, well, stocks trade from supply to supply and demand to demand, and if you are looking for a different alternative of not burning mental equity, okay, what you should consider is trading that 1% risk, okay? Should consider that trading that 1% risk, because it is a valid way. It really is a valid way to put yourself in a position that slowly, and again, it doesn't happen overnight, but it does give you a position to put yourself slowly in a way that you are trading eventually very technically instead of trading very emotionally. So for example, I trade, I would say 99% very, very technically. And again, a lot of people will turn to me and look at me like I'm a robot, but it took time to do so, right? It took time. It didn't, I wasn't trading mechanically overnight. It took years and years and years. And you guys kind of see that in the room. Every single day. So here's another live example, right? Here's another live example just to give you guys an idea of, just again, risk management. So here's an example of WUBA. And people are going to say, what? Yeah, WUBA. If you believe in the theory that you want to let winners run and cut off your trades with small risk, well, this is it. This is the formula. Okay, this is the formula. Yeah, that's too little. 0.01% is too little. I think personally, you need to have some sort of exposure. Now, again, this has nothing to do with pivots, right? This has nothing to do with pivots. This is more of a structural balance that if you're trading for a longer time frame, okay, if you're trading for a longer time frame, that you can maximize value in a potential setup and still have a fixed cost rate of action that you can take. Okay, pivots are completely different. Pivots are completely different. As everybody knows, I don't like risk on these pivots. So I know, for example, if a pivot is 346 and it goes through the whole number, I know I'm fighting time. Okay, I'm not fighting the number, I'm fighting time. So for me, if the stock doesn't go within the first couple of minutes and builds on that pivot, I'm not risking anything. You guys know this. I'm not risking anything. So for example, if 346 is the pivot on Tesla, okay, and there's 12,000 offered on Tesla at 46, and it only goes up 20, 30 cents, and then the sellers come right back, we know that pivot is, that pivot for that interval is broken. Okay, we know that interval for that trade is broken. So why would I risk any money on the trade? Correct? Why would I risk any money in the trade? Why would I risk 0.5%? Why would I risk 1%? Why would I risk any money? If the market is telling me the sellers are still in control of that pivot, why should I put myself in a situation to risk any money? But that's me. That's on on a very aggressive intraday cycle on the 60-minute channel. So I know if I'm entering Tesla, especially at a whole number, that whole number should supply an incredible amount of aggressive reality for buyers, because the whole number is the greatest amount of liquidity you can have. So if the buyers come in and they still can't clean up a seller at $46, why would I continue to stay in the trade, right? Because Tesla's not going to come in 10 cents. Tesla's going to come in $2. So why should I risk X amount of dollars if I could risk, zero, or at least, with slippage, maybe, risk 20, 30 cents, which is still nothing on a Tesla trade. So the moral of the story is here, I think a structural balance is very, very important for a new trader. I think it's incredibly important. I think it's the faster you get rid of emotional attachment to the market, the faster you can start thinking clearer. I think the faster you can start looking at this business for what it is. Okay, technicals first, opinions, well, they don't matter. And third of all, again, you are putting yourself in a position to live out longevity, to live out that scenario that you are trading based on your terms, not when the market tells you to exit, okay? So, this is kind of, and again, we talk about this kind of stuff in the live webinar all the time, okay? There's nothing that we don't cover, but I think it was still very, very important to kind of put this on video so you guys can have that option, okay? Can have that option and say to yourself, well, I don't want to risk a lot of money, but I do want to give myself the biggest bang for my buck, okay? So I hope that this is kind of a scenario to give yourself just another option, okay? Just to give yourself another option of putting yourself in a position to organically win, okay? So at this point, guys, we'll take questions for about 10 minutes, okay? We'll take questions for about 10 minutes, and then we will go about our Sundays, and we'll see each other again in the live webinar.